Good morning, everyone. My name is Dormer Stephen. I'm the chair of the business department at Shipman & Goodwin here in New Haven. Welcome. Our panel is the state of the VC market in biotech. I'll let each of the panelists introduce themselves and their firms, and then we'll get started on the discussion. Liam, do you want to start?
Hi, everyone. I'm back. Just by quick introduction, I head the biotechnology group within Access Industry. It's quite an echo. Okay. Maybe I'm too close to you. So Access Biotechnology was set up 4 years ago, and we invest in therapeutics and therapeutic platforms across stage and across public and private, mostly private stage. I've been investing for 14 years. Previously was at New Leaf Ventures, and prior to that I was in the neighborhood here. I was global head of clinical R&D at Pfizer, based in New London. Let me pass to my left to Stacey.
Thanks, Liam. Hi, everyone. I'm Stacey Seltzer. I'm a partner at Gurnett Point Capital. I'm a little bit of an interloper here in that Gurnett Point Capital is more of a private equity style life sciences investor, although we invest in products. So we like to call it de-risked life sciences investing, where we invest in regulatory or commercial stage programs. Before that, for 14 years, I was at Ascent Capital doing more traditional life sciences venture capital. Also, before that, worked at Schering Plough and marketing and business development in Big Pharma. And before that, started my career as a consultant for McKinsey & Company.
Hi, my name is Fei Shen. I'm heading the Boehringer Ingelheim Venture Fund in the U.S. I think Boehringer Ingelheim Venture Fund is the opposite from what Stacey do. We like all the risk we want. We do company formation. We do seed the lead. And we will follow the company from A to B all the way until the crossover round. We no longer follow in the crossover. So myself, I'm trained in neuroscience, worked in research and development for 15 years before switching to the venture fund 3 years ago.
Hi, good morning, everyone. Kevin Bitterman. I'm a partner with Atlas Venture. We're based up in Cambridge. We do about 2/3 in-house company creation and about 1/3 more typical venture investing, but we like early seed stage. We do that across therapeutic areas, across drug modalities, assets, platforms. We work with a talented group of EIRs in our offices to put things together from scratch. I've been in Atlas for about 6 years and spent 13 years at another Boston-based venture firm before that.
Hi, everyone. My name is Maha Katabi. I'm a general partner with Sofanova Investments. We're based in Menlo Park and actually soon in Boston as well, so we're expanding to the Boston region. We've been investing in venture based on an approach of focusing on therapeutics for the last 4 funds, I would say, and now investing Fund 5 along the same strategy. I joined Sofanova about 4 years ago as a general partner. Before that, I was also a biotech investor, but in a bit of a different role, managing public equities portfolios and investing in crossover rounds mostly, and started my career about 20 years ago now, doing very early stage venture, similar to what you are all excited about, starting up companies from university technology. Nice to be here.
Super, thanks. I'm Matthew Harrison. For the last 15 years, I've been a sell-side analyst covering biotech stocks, and for the last 10, I ran the biotech coverage group at Morgan Stanley. This Tuesday, so the beginning of this week, I actually transferred to investment banking, and now I'm a coverage officer at Morgan Stanley for investment banking in biotech.
Great. Well, let's start with the question that everyone here wants an answer to. What is the state of the biotech market for venture capital?
Everything is awesome.
Do you want me to go first? Why don't I go first? I mean, I think my view would be the public market bottomed probably last summer. It hasn't really gone up from there. It's bounced around a lot. I've always thought of the private market as being a year or so behind the public market. So, hopefully we're sort of at that point, but I think you're seeing some stuff get done, but as I'm sure other panels have said, the bar is quite high and much higher than it had been 2 years ago. And later is better, and very late is really all you're seeing get done in the public markets right now. Everybody's hoping that will change. The flip side is there's capital, right? Capital still exists, and people are open for business. It's just that the threshold to do something is quite high.
Yeah, I was only partially kidding when I said everything is awesome. I think everything is relatively awesome, and we need to kind of take a step back. Certainly things aren't what they were a few years ago, but speaking from an Atlas point of view, we think that's a very good thing. It's not healthy for the market or the broader ecosystem if, and many of you may not want to hear this, anyone with a business plan can go out and raise $100 million Series A, then raise a crossover round and be public. And that frankly happened, and not surprisingly, way too many companies went public. Capital went to the wrong ideas, to the wrong management teams. So this market is cyclical. It always has been, it always will be. We're in a different part of the cycle than we were a few years ago, but we're also in a much different ecosystem than biotech and early stage biotech had 12, 15, 20 years ago. There's a much more sustainable pool of capital that exists, and an ecosystem of specialist investors to continue to be able to support the right companies, the right technologies, and the right management teams, even through tough times. So financings are still happening. They're taking a little bit longer. Clinical data is still being rewarded. So the fundamentals are very strong, and I think most people take the view that this is a very healthy correction long-term for the sector.
Yeah, and the thing we see in this market is kind of winner takes all. So it still have 70 million, like 100 million kind of round, the first round, but usually it's very much fewer than a couple of years ago. Most company, I think, have a hard time to raise, and there are even some of our portfolio company, we will have to have more internal bridging happening to extending the runway for a company to take longer time to raise the next round. But I think, like Kevin said, it's a very healthy correction for us. And it's just the right idea to get the right capitalization and to the right inflection point is what we should do.
I wish any of us would be able to predict when this will change. So I echo what my colleagues are saying, that yes, this is a welcome correction, but the reality is we live in a very uncertain period. Uncertainty about trajectory of the economy, interest rate, and macro has had a huge impact on biotech. So most people would tend to believe or want to believe that it's quite uncorrelated with the rest of the equity market. But being a business that requires significant capital, we are an asset class that is impacted by what's going on around us. Because of the longer duration. And so what we are seeing is essentially a flight to less risky assets, whether it's in the public markets with an IPO like Acelerin happening, but clearly with much more advanced programs than we had seen in IPOs over the last couple of years, or pharma companies looking for M&A, but all or most M&A transactions have been focused on products that are significantly de-risked with phase 2, phase 3, and even commercial. So that's the general state of mind for biotech investors.
So within Access Industries, I get exposed to multiple other sectors, and what's been interesting is seeing that we're not alone. The tech sector has been very negatively impacted by the change in the market dynamics, and I think even more so than biotech. So I think what Kevin said is true, that biotech has some fundamentals which continue to be positive, and I think creates a new normal for us this cycle. But I look at my colleagues who invest in pure tech, the world is really quite different this year than it was 18 months ago. And it's hard to see how that changes, apart from AI perhaps evolving away. So one of my reflections is, what does this market actually, what has really changed in how companies are behaving and how investors are behaving? And it's interesting, there were a lot of new public companies created in this last cycle, and many of them have not done well. So you're seeing a shakeout of small public biotechs that are actually going bankrupt. This is something that we haven't seen in our industry, but companies actually literally going bankrupt or going through a process of recreation as shells and licensing in or merging with other companies. And I think that's probably a healthy process of clearing out what happened before. But that is creating some opportunities. So creative opportunities for financing companies is finding shells that have some cash in them. The other thing that's happening, I think, on the private side is the round that's getting very difficult to finance is the Series B. So there was companies were supported with the initial Series A funding, sometimes quite large rounds. But when you look at the next round, 2 to 3 years or 4 years on, raising a Series B is proving to be quite challenging. And the playbook there has been insider rounds or insider bridges, or a combination of insider financings plus strategic partnerships on platform-type companies. But I would say, if I was to characterize one stage that's getting quite challenging at the moment, is the private Series B rounds.
The biggest difference I see between last year, which we called the bottom, and this year in the public markets is last year, no matter what the news flow that came out for a company, stock went down. If it was a bad trial, stock went really far down. If it was a good trial, stock went down almost as much or sometimes even more, because people are just so worried about the money coming into the ways for the company to get more money going forward. And now you're seeing a more rational approach that when a company has good data, you do see at least a stabilization of the stock and sometimes even an uptick in the stock. And that's, to me, that's a sign that the market is acting a little bit more rationally about what these programs have and what they can do. But investors have gone back to more values-based investing. They're really looking for not just the hopes and dreams of the biotech early stage, but they're actually looking to see concrete evidence that these programs are moving forward, so that they can really believe that there's a product at the end of the rainbow. Whereas 3 years ago, any idea was fully valued as if it was definitely going to get to the market and be $1 billion drug.
So for your companies that have raised a Series A round, knowing that the Series B round may be challenging, or even the Series C, what are you counseling your companies that have been funded today to how are they adjusting, knowing what's coming?
So I mean, what we've told our companies over the past couple of years is, don't empire build, don't build up huge infrastructures, because you're going to need to save that cash for a rainy day. And so the companies that survive and live to fight another day are those that keep the reserves and understand that it's going to take longer to do everything, especially fundraising. And building bigger isn't necessarily better. Getting to the key answers is what you really need to focus on in a market like this.
Yeah, I think it's just back to basics. It's making some tough decisions early on. If you have a platform, maybe you're focusing on 2 programs instead of 4. You're being very aggressive on business development and partnering earlier than you otherwise may have. You're over-syndicating a Series A, so you're kind of pre-building the Series B syndicate, to Liam's earlier point, so that the insiders can anchor the next round, and you're controlling spend. So again, these are all just healthy, fundamental things that it's good for the industry to get back to.
I was going to say, I think one of the biggest things I've seen is you used to fund, you'd have companies that would come with 10 preclinical programs and say, we're going to push them all at the same speed, and we're going to have 10 phase 1 programs, et cetera. And that didn't used to be the way this worked. You had one program, which was your major de-risking catalyst. And so you've seen a real turn back to prioritizing a single program and maybe a backup to that, as opposed to a very broad, everybody was a platform company kind of ecosystem.
And also, so my colleagues speak here about the saving, but I think another thing is try to draw as much non-diluting as possible, not only from the M&A collaboration part from the farmer, but also the non-diluting grant from SBIR, all different sources. They can make the company last longer.
Yeah, to that point, are you seeing more BD deals, collaboration deals, where they're partnering a lead asset to provide non-dilutive funding for other programs to really fill in the gap on the equity investment that would otherwise be the natural extension of the company?
So I think speaking with all big farmers seem to be more bipolar situation. Like Stacey said, maybe farmers actually are more interested in de-risked portfolio. They like to be phase 2, phase 3, late stage. But another thing we see is people want to go very early in research collaboration for target discovery without any really asset-driven. That's really benefit for their platform companies.
We personally haven't been advising our companies to partner their lead assets. I think that remains sort of common wisdom in biotech that you need to maintain the upside. There are certainly exceptions to the rule. So if you are able to strike a partnership where you do retain a significant portion of the upside, there have been historically a number of transactions. And the one that comes to mind, for example, is Pharma from a number of years ago, where they did partner the lead asset and then had a great acquisition. But by and large, that is not the recommendation to go out and essentially sell your crown jewel. But if you are able to warehouse some of the programs that you're not advancing, if you are able to leverage those in non-dilutive funding or expand the research scope of what you're doing by interesting pharma, these are certainly very desirable. And there's been a trend in banking, and maybe Matt can comment on that, where every M&A advisor is suggesting that starting the conversation along the lines of a partnership and maybe going further down the road along these lines is what ultimately has driven some of the most recent M&A transactions and some of the public filings that we've seen. But consummating a partnership is probably not the route to go.
Yeah, I would just say quickly, partnering your lead asset is still kind of a last resort, but there are creative structures you can pursue. So we've built a number of companies as LLCs, particularly towards the goal of partnering your lead asset is really selling the company. But if you're structured as an LLC, there's creative and efficient ways that you can actually sell an asset at a time to different people, whereas you can't do that in a traditional C Corp. So Nimbus, which just sold its lead asset for $4 billion a couple of months ago, was a good example of that. Other examples where a company can be acquired, but the acquirer may only be interested in the lead program, and you can actually spin the rest of the enterprise out and then kind of do a version 2.0. So you are seeing more of those creative structures in order to take advantage of some of that value, but be able to unlock the value in the pipeline and the platform as well.
Are you seeing interest, or do you have interest in platform plays or multi-asset plays the way maybe you did 2 years ago, or are you more single asset, more capital focused plays?
I would just say from an Atlas point of view, we've always been a balanced mix of both. And if you try to say, hey, the market only likes assets, we're only going to do assets right now, you're constantly going to be chasing the pendulum back and forth, because by the time it's ready to transact on that, the market's going to be in a completely different place. And so throughout the boom times, when the market really only loved platform opportunities, loved sizzling technologies, the ability to build both asset and platform companies was important. A lot of those platform companies went public, got well-financed, and are developing programs, but the asset companies that are now at a relatively mature stage are being targeted for M&A or other partnerships. So again, I think you can't try to chase what the market sentiment is at any one time.
And the other thing I would just say is the market sentiment may be different than what the pharma sentiment is. And so you need to have that balanced mix, because a lot of times pharma is looking for sustainable pipeline. And so platform companies can offer that.
Yeah, the way we have played in the space is for the few, we don't do too many, but for the few preclinical companies we've invested in, they have had platform nature with multiple assets that allow a different model. Yeah, so the company can advance some programs themselves and then partner others. And we've been in those discussions about partnering your lead program versus not. And it can be quite an interesting discussion, because sometimes that's your only choice. And if it is, then it's about the creative partnership that you can get. And there are some interesting creative partnerships for even preclinical assets that some of our companies are pretty advanced in discussions right now. But for later stage, for us as investors, we emphasize single asset models and the value that it creates through investing in a program, through clinical proof of concept in particular.
Yeah, another thing I think we cannot really characterize it just platform versus single asset. Even platform company, you always ask company to move forward a lead asset that can validate your wonderful platform. And I agree with everybody, should not partner out of the crown jewel, but the partner on the platform potential, on other potential program with partners, not only just getting the money, but also learn something, getting leverage on their expertise and strengths to help you move on our programs that you don't really have energy or expertise to move forward. That should be, I think, more advantageous for the company.
Have you seen the same level of activity and interest from pharma on early stage, either target discovery or early stage preclinical programs, and it's just a question of economic terms, or has the activity itself dropped off?
I would not say the activity drop. I think farmers still very hungry, and we all know, in addition to what we do in-house, we have certain strengths, but we also have a lot of unknowns. That's what the external innovation groups like us, venture fund, BD, and some more research beyond the core therapeutic area function do. So we do collaboration, we do invest for equity and BD just for M&A. So I don't think the hungerness from farmer decrease in this market. But everybody do know that right now is a buyer's market. So people can negotiate and can, have different terms. That is go with market.
The other thing I'd comment on is, depending on where you are in the spectrum of development, you're dealing with different stakeholders within Big Pharma. So if you're talking about early discovery and platform programs, you're mainly dealing with the research part of pharma. When you start to get into phase 1, phase 2, phase 3, you're not only dealing with the development group, but you're also dealing with the commercial group, who has very different priorities and is thinking about risk-reward trade-off in a very different way. So in this market, for folks dealing with the commercial organizations, they're very much in the show me camp and very much focused on, is this really going to get to market, and I'm going to really be able to build my commercial organization based on this drug, whereas the R&D organization has, much more, a very different, much longer term focus and looks at risk reward very differently.
One thing that we've observed, the level of partnering interest for early stage, I think at Pharma is quite high, but it's also quite refined. And so company A may have a remit to say, go do a molecular glue deal. Company B may be focused entirely on non-viral delivery. Company C on NK cells or whatever the case may be. And so there's clear remits coming from up above, and they're going out and hunting for very specific technologies and specific niches.
So we've heard a lot of de-risking and looking at later stage assets. What recommendations would you have for a faculty member who's thinking of spinning out an asset to a new co to look to finance it? How do they bridge the gap in terms of creative non-dilutive capital, government grants? What have you seen venture philanthropy? What have you seen be successful? How do they get to that de-risking? How do they finance that de-risking point?
You've listed a lot of the options that do exist. I think chatting with some of you actually yesterday, there's still a lot of interest in funding the early stage work as soon as you have, say, in vivo data, for instance. But funding it at the concept level is probably what's dried up. So I would advise, that whatever funding means one can find to generate de-risking in vivo data that guides the future in terms of where do you go with drug discovery, with optimization, how have you de-risked the program so that the translation to a clinical program becomes much more efficient. These are some of the aspects to consider, and all of the funding sources that are available that help you get there will facilitate setting up that Series A, because essentially our goal is to set up a Series A that gets you very close, if not at the clinical proof of concept stage.
Yeah, I would just do an advert for Yale Ventures. There's a very active group here at Yale that is plugged into a lot of sources of non-dilutive capital, grants, etc., that hopefully can help you navigate. And I would also just advertise the Blavatnik accelerator we spoke about earlier this morning as a potential source. The intent is to help bridge that gap that Maha described, to create in vivo data that is exciting and investable for a Series A.
So I think, there are a number of the college venture group are very sophisticated, including Yale Ventures. They outreach very early, very proactively to all the funds doing very early work. So like I think for Atlas and their BI Venture Fund, it's never too early for us. You can have a concept, start conversation with us. We don't even need to have any in vitro, in vivo data. We can just discuss a concept and maybe providing a note for a very focused study for go, no go. And if it turns well, then we will converting into the next round and make a 20, 30 million round for you. So I think there are different mechanisms, but I think talk to the right group, talking to the PE group for their concept, that just waste energy. Talk to the group truly will go into do company formation. Engage conversation early. I think that's very key because doing company formation takes us a year or two to make one company. So do the right study, design the right study for what really the value adds for your platforms. That's really, I think, the key.
Yeah, I would also advertise for Liam and Blavatnik. I've had a front row seat of the immense impact that they've been able to have on bridging that translational gap. Another university up in Cambridge that I'm not allowed to mention here. But I will say, even in this environment, so you'll see a firm like Atlas participate or lead a silly $100 million Series A, but the vast majority of investments we make in companies we start at a much smaller scale. And so $2 million, $3 million, $5 million to run the next set of killer experiments and to buy down a significant amount of risk. I mean, our job is to find those opportunities where for a reasonable quantity of dollars, you can take out a lot of risk and set the company up to be able to absorb much larger rounds of financing. So there are still a lot of funds out there, some of them represented here, that love early stage, that love taking those big swings.
And for all of the companies in Connecticut, I'll put a little plug in for Connecticut Innovations. They have a wonderful angel tax credit program that they run, which is a 25% credit for angel investors, and they're matching seed programs. So those are, if you're a Connecticut-based company, that's another alternative for you. What about areas that are attractive right now? Fields or areas that are attractive, and maybe some fields or areas that are not so attractive from your perspective?
I'll introduce a topic called the Inflation Reduction Act. So you might wonder why that comes up in response to that question. But one of the unintended consequences has been a de-emphasis in some companies for developing oral small molecules, particularly for indications like oncology that involve the Medicare population. And for those who don't know about the Inflation Reduction Act, there's a part of the act distinguishes between large molecules and small molecules in terms of essentially time where you have an exclusive period of selling without enforced negotiations on price. And it's a 9 versus 13-year difference that's embedded in the act. This, I don't believe, was intended, but what we're seeing is one area that has been an area of high interest for us in the past, which is small molecules for oncology, has suddenly become less interesting in some aspects. In other aspects, it's driving a different approach to discovering and developing such molecules by moving more in parallel and doing more upfront at-risk investment, particularly in the clinical stage. So putting 2, 3, or 4 trials in parallel rather than in sequence. So that's created a different dynamic for investors. It's in some of these example therapeutic areas that I think it's having a broader reach and a broader impact on our industry than any of us realized when we first read this legislation that came out.
And I would just highlight also there are other therapeutic areas which are sort of carved out. So orphan diseases as an example. don't fall into the act, and so there's a lot more interest I've observed in orphan diseases, either from an M&A standpoint or just from a development standpoint than there might have been, and so that also lends itself towards some of the newer technologies where you can also have better pricing for smaller populations.
Yeah, the one caveat to that, which is another unintended consequence that Liam mentioned, is for some orphan diseases that will always be orphan, that's absolutely true, but there's an age-old playbook in our industry of this rare to common strategy for a small company. You may have a target or a pathway that is involved in something massive like coronary heart disease, but there's a nice orphan small population that you can very feasibly run a trial on a small molecule. The reason that that's no longer a viable strategy, because it starts this clock that Liam mentioned as soon as you get approval for this orphan strategy, and big companies will no longer be interested if you started to eat into their exclusivity period for their massive market. So it'll be interesting to see the balance of the interest in orphan across that.
And I think it's also, what Liam talked about, which is it's also a much higher bar to make that investment than it used to be. So you used to be able to run, to your example, maybe a $10 million program or whatever to get to this small indication and get some proof of concept. And now the large company has to say, well, am I going to run a $500 million outcome study because I have to run that before I can bring this to market? And so it definitely has changed risk reward for people.
So I think on the positive side, what we're seeing is if you're developing an antibody for a disease state that doesn't affect the Medicare population, autoimmunity, or has a big population that's younger, for example, autoimmunity or chronic inflammatory disease, those areas are becoming more attractive and attracting more interest.
Other changes have also impacted oncology, so that's somewhat related to the Inflation Reduction Act, certainly for the small molecule oncology products. One approach had been to get to market as quickly as possible through the accelerated approval path. But now with more recent guidance from the agency where you have to be enrolling your patients into larger randomized registration studies has also changed the strategy, both from an investment perspective, how we devise clinical development plans and budgets, but also in general from investor appetite for oncology in particular compared to the other categories. So there's definitely been a switch, I guess, or maybe favoring areas that had been out of favor over the last few years.
So maybe I switch gear a little bit to talk about our strategic venture fund. So I think by the name, you guys already guessed we're the strategic venture fund for Boehringer Ingelheim. A little different from some other strategic venture fund, the CVCs. We are doing white space creation. So we do not invest in anything our parent company, major TA, is working on. If you have such an asset, I will be happy to connect with you, with our BD colleagues. So we do company formation for 5 or 10 years ahead of BI would like to do. So more than decades ago, we start going to immuno-oncology with BI don't have immuno-oncology TA, with the hope that when we incubate our company for 5-8 years, that will fit into help our parent company to have a choice to internalize some of the immuno-oncology company and provide a head start for building the commercial infrastructure simultaneously when they also building research organization and putting asset forward. So today, I think immuno-oncology we still do because that's our legacy investment. We are not doing anything like say this morning Andy's group or Lamin's group is doing for their immuno-oncology TA anymore. We will look into the intratumoral microbiome, this kind of unique play. We feel that area is emerging. That's one example. Another big area we play in is regenerative medicine. So we do cell gene therapy. One area where folks are right now is the immune cell, T cell repertoire regeneration, including the thymus regeneration and how to really, when people getting older, how to change this involution of their thymus and change the commitment towards myeloid cell, towards lymphoid cell. One more area we also will focus on is digital health. But digital health have to be in scope play for whatever can help our parent company to facilitate recruitment for the patient trial they're running, or biomarker strategy for diagnostic, or ultimately have to be a AI play. The product has to be AI. But last not least, we are very uniquely playing into antimicrobial resistant. We're together with AMR Action Fund, and we also made a joint venture in France for Orobac, together with Evotech and Biomedium for diagnostic. So that's a very unique play for us for antimicrobial resistant.
How about AI opportunities in biotech? Have you seen interesting opportunities out there?
Yeah, you can't not see them. So it's an interesting time for AI right now. I think from our perspective, to take a step back, AI has been impacting drug development for 2 decades. It's not new. AI ML has been used by computational chemists and at various parts of the drug discovery process. Clearly, there's been massive innovation in the space. And from our perspective, the opportunity set kind of bifurcates between folks that very unrealistically look at AI as this ability to completely transform the drug discovery process and shrink it down from years to a few months and take out all the risk. That hasn't panned out. Many companies have set up to do that. They've raised hundreds of millions of dollars. From my perspective, every single molecule that's come out of those has been a target that the industry has known about, again, for 20 years. You spend $200 million, run this complicated computer model to find out we're going to develop a MEK inhibitor. It's not that exciting. But the opportunity for AI and ML as a tool in the hands of a seasoned drug developer is absolutely massive. And I think we probably still don't appreciate the impact that it's going to have at various places along the way, but you absolutely have to marry those technologies to the art of drug development, someone that spent 25 years doing medicinal chemistry inside Merck. And that's a very powerful and potent combination, and I think will lead to interesting things. So the last thing I'll say, I actually think the more proximal impact of AI and ML will be downstream in terms of thinking about things like clinical development, trial selection, patient segmentation, et cetera. I think we're probably a little over-optimistic on the near-term impact it's going to have on discovery.
Yeah, I would just echo what Kevin said. I mean, a lot of the first companies you saw come out, basically the pitch was, we will take drug discovery, which normally takes 10 years, and everybody's heard the number, $2 billion or whatever, and we're going to turn it into 1 year with a target, and it's definitely going to work. That's not what you're seeing, but what you are seeing is very important but marginal gains across the entire life cycle. And I think where you've seen it and where organizations can measure it the most right now is in what they're seeing in their commercial sales force. I think it's being deployed dramatically there. What you're seeing in trial recruitment is pretty exceptional in a lot of cases, especially in rare and orphan diseases. And then you are starting to see it, and to Kevin's point, right, I mean, it's not like it's new in drug development, but where it's deployed at a very specific kind of problem, right, it is speeding up those specific kinds of problems.
Yeah, I would say when we see a company coming and pitching AI, ML, we're highly suspicious. and largely because we, in our industry, are skeptics about technology until it's proven or showing promise. And there's a lot of things that are put under the banner of AI, ML, as this is a button you can press and a drug will come out that is sold to investors. And I remain skeptical in general. Having said that, as Kevin has said, there are companies like Schrödinger that was the basis for Nimbus that was using technology which we would now call AI and ML 20 years ago, and is still using it and modifying it in the chemistry space. That is just remarkable and is really very additive and value additive to our industry. And there's more like that that are really part of a genuine process. What we see pure play technology companies coming to us is a complete lack of understanding of biology and the uncertainty that biology represents. So a computer and a computer model can get you so far, but when you get to real biology and complex biological systems, never mind complex toxicology, you're in a different world. And unfortunately, the people who generally come to us are technology people and not drug development people, drug discovery people with these ideas. I would also say I'm a firm believer in the application of such technologies in development. And 15 years ago at Pfizer, I was very involved in the whole application of PK/PD modeling and clinical trial simulation across the whole of Pfizer's drug development enterprise. And I believe they continue to scale that effort and use all that you can use from rich data sets that allow you to predict dose interval, and also help select patients on clinical trials. And that is absolutely the way to go. It's here. It's not new. It's here already. It's getting better. I believe it's getting a lot better.
Yeah, so I want to drill a little bit on what Kevin touched on. One portion of the AI is really on the clinical trial per se, and that's what the digital health we are investing in. But I think, doing therapeutics, we've been doing decades, and we're very good at how to do the, IPO trade sale. That's a very known market, I think, for us to go through. But digital health, I think we're still learning. So our fund only started doing digital health 4 years ago. And we learned something, I think, quite useful, I think, to share with all the investors here, is how to really exit such digital health company in the service sector. It seemed to be only really the top one can be exit towards a strategic venture fund like CVC or Optum, those type of the payer for value-driven outcome-based the trial. But the early ones, you can form a lot of collaboration with different pharma. They will welcome that. But when we really try to exit to any pharma would say, why should I buy it? I can just pay for service. There's no reason for me to exclusively own this. So I think that's a lesson for us to learn. I think the whole field is evolving, how we really exit those type of digital health company.
So I'd like to use this time now to open it up to the audience if they have questions for the panel. Raise your hand. No one has a question. Wow.
I guess everything is super clear.
Since I'm sitting closer and you can all hear me. So in terms of therapeutic areas, what has been coming back into vogue or into the foray is the cardiovascular, cardiorenal. Any thoughts on that? What you would like to see in that area?
So I think in general, cardiovascular and cardiorenal, a lot of those trials ended up being extraordinarily large and take hundreds of millions of dollars. So finding niches in that market that can be investable as a venture group is very important. And then if you can get public and you can access large amounts of capital, then you can do the large outcomes trial. But you really have to, as a biotech company, think of what's in the realm, what's in the art of the doable from a financing perspective from venture groups.
Yeah, I would say renal is one area we've been quite intrigued by over the past couple of years. There's some beautiful genetics, a lot of unmet need. One of the big challenges with renal in particular has been just getting drugs there very specifically. So we have a couple of efforts going on looking at drug delivery to the kidney very specifically, and that's part of a broader theme of thinking about delivery. We have a lot of amazing medicines, genetic payloads that we do a pretty crummy job getting anywhere but the liver. So I think there's a pretty significant opportunity across the board to open up different tissues to those medicines.
And the interest is also driven by changes at the regulatory agencies where they are willing to accept either better stratification of patients or biomarkers or surrogate endpoints while you run subsequent larger trials that would get to, for example, in renal function as measured by decline in GFR, for example, which we all know takes at least 2 years to measure. So whatever compresses the timeline usually makes an area much more investable for venture. So that's certainly been the case in renal. In cardiovascular, yes, there are indications also that have come to the forefront, and it could be pretty broad. So PAH, for example, is an area that has seen tremendous innovation in the last couple of years, and these are relatively manageable studies to conduct. certain segments of heart failure as well have become much more investable, and certainly there's large areas of unmet need in all of these indications.
Yeah, it's interesting to reflect today. The two biggest companies by market cap are Lilly and Novo in our sector, and they are diabetes companies who have made incredible strides in diabetes, but also you could say cardiovascular risk and now weight reduction. It's not an area that our venture industry has really been in to an extent. It'd be interesting to see if it changes, and how that might change. But the barriers have been tremendous because you had to do these large outcomes trials to prove benefit, and of course, big companies can do that. Typically, small companies cannot do that. But it'll be interesting to see how that may change the landscape.
I wanted to ask a very similar question that was just asked, but for a riskier topic, such as neurodegenerative diseases.
Yeah, I think you're seeing a lot of activity in CNS. Again, just speaking from our perspective, there's kind of two streams. There's taking advantage of the ever-emerging genetics that exist. There are now a lot of quasi-validated targets. There's some just fascinating biology, lysosomal biology, et cetera, that a lot of companies are taking advantage of. And then the other stream, again, is delivery. If the blood-brain barrier has been this perennial challenge for drug development. So I think we're seeing sort of I don't know whether it's the second, third, or fourth wave of BBB penetrating technologies, but I think we'll see a lot of that over the next 5 to 7 years.
Yeah, I would just sort of reiterate that there's also been, I would say, a renaissance in investment in neuropsych too, where the sort of risk-benefit is a little bit different than very intractable CNS diseases. And so I think from an investor standpoint, there's been a little bit more willingness to invest in neuropsych. And then, also in pure CNS, there are, I would say marginally, right? I mean, the regulator is at least willing to talk about biomarkers, which hasn't been the case for years. And so I think that's made it a little bit more tractable as well.
A confession, I ran 6 Alzheimer's programs at Pfizer, and all of them failed. So I haven't invested in Alzheimer's disease in the last 14 years, but that may change. I think that we've always got to be open to progress. And one thing that has changed in 14 years is I think the diagnosis of Alzheimer's is now much more accurate. When we were running those trials, about half the patients didn't have Alzheimer's. We didn't know that because we didn't have the imaging modalities that we have today, to look for tau or amyloid in the brain. So that's just one simple change that's happened, as well as obviously now being able to select patients based on genetics. So I think on the clinical trial side, dementia has improved in terms of executing trials. There's still a significant risk, obviously, on the translational stage.
Yeah, I think I agree with Lynn. I think so diagnostic, I want to talk a little bit about patient stratification. For small biotech to invest in for neurodegeneration for Alzheimer's, it's kind of unrealistic for us to believe they were able to take drug all the way through. So I think if you can link for back translation from a certain patient population, maybe IRA gets into the way, but I think if you can figure out a patient population has a genetic clinical anchor and utilize these type of target to have a sentinel indication, then I think the neurodegeneration become a lot more easier for us to imagine what's the patient stratification strategy we have in clinic. Need to be kind of more, I would say, dotted line and much more solid in the neurodegeneration pathway.
Emerging infectious diseases,
Yeah, so when I said antimicrobial resistant, we defined that strategy before even COVID happened. We have been investing for 3 years already when we defined strategy 5 years ago. And when we did that, so we exactly like what you said, we feel there is a lot of neglected disease, and if big pharma, we are creating white space. We never can predict in 10 years what's going to be hot when we invest in a concept. So we define as novel mechanism of antimicrobial resistant seem to be such a medical need for patient, and for BI, we're patient-centric. We really want to create a medicine that make a difference for a patient's life. So that's kind of our ultimate goal, no matter which section we set. So with that notion, we did, as a venture fund, we invest $100 million into AMR Action Fund to help them to push in from the market perspective for the pool and the push incentive. For our venture fund part, we go into very early spin out from academic center. This part of the area is being very neglected. They cannot really find any venture money. So we are really together with Novo Repair Fund, together with a number of funds with similar mindset, going into with this mission to really, nail down that. The middle portion, as I said, we did our joint venture in Lyon with Evotech, together with Biotech. That's really mean for the drug discovery part, pushing from late stage of research into phase 1, phase 2. So with that 3-pronged approach, we hope we can really move the needle in that field.
So I think the big problem in the anti-infective space is the disconnect between the unmet need in the early stage innovation and the lack of products who have performed well actually on the commercial side. So if you look at launches of the last 15 or 20 launches of antibiotic drugs, there are precious few antibiotic drugs that actually make it past 50 million in sales. There's this problem of stewardship, that the drugs that are used in hospitals, the hospitalists hold them back and don't actually use them until they're a drug of last resort. So from a venture capital perspective and from an investor perspective, unless you have some sort of bent like AMR Action Fund or Novo Repair Fund, it's hard to make that investment at the early stage because you don't really don't have a good belief that you're going to be able to have these drugs do well in the commercial market. As an investor on the more commercial side, we've been looking for opportunities in the anti-infective space looking for those ones that buck the trend and actually do well in the commercial market, because there are a few, but the problem is, Series A, Series B, Series C, they all see all these failures in the commercial space, and it makes it much harder to get excited about something that really does actually treat a huge unmet need.
So let me first say, I agree with Stacey. I think this area is not just only the market is broken, the whole chain is broken. Because we don't really see the money going into that, a lot of talent were lost in that field too. So when I form a new company, it's very difficult to find a committed CEO to really go into this field. So that's just one example. But I think we see hopes, right? So in Europe, they just passed an transferable orphan AMR voucher for able to allow encourage the discovery for novel mechanism of antimicrobial resistance. In here, many discussion has been happening with Pastoral Act, with a subscription-based market access rather than volume-based access. That's a very different market. It was slowly moving there. I don't think we can rely solely on policy alone, but I think it's good to see things are moving towards direction. But as I said, some funds are, rather than chasing the spotlight, we do not chase the spotlight. We're hoping to define a strategy and working there for 5-10 years. And because we're evergreen fund, we don't really have the pressure from LP need a return within a certain frame. So I think we are able to really, hopefully with the field together, move the needle a bit.
Your question's a fantastic question because it sort of goes to societal awareness. We just had this existential crisis, and we forget. We forget that there are other infectious agents around that we cannot treat well today, and there are more coming. But society is still not really willing to pay the way it's been described. Stacey and I worked on a drug, a company called Durata, a drug called dalbavancin years ago. It was a successful investment for us, but the product hardly sells, in terms of revenues. It's a great drug. It's a long-acting lipoglycopeptide, and it works. But the hospitals are not willing to use it unless in reserve, as Stacey described. So something has to change along the lines that have been described in terms of the economic model. The volumes are so low. Something has to change to incentivize at least the kind of groups that we represent to get into this space. Otherwise, it's going to be, we'll react to the next crisis when it happens.
What about diagnostic therapy and vaccines to prevent getting to the crisis point?
Yeah, I think we're out of time, but the answer is they're just not investable from an early stage perspective, unfortunately. I mean, there are answers to that. It would be a much longer discussion, but today you're just not going to get a lot of interest, unfortunately, from most of the venture community.
Please join me in thanking our panelists.